Welcome to Gold Weekly. I apologise that it has taken so long to come to Gold Weekly 5. The last 3 weeks has been most interesting, and we're going to cover those in this, so it'll be a bit longer than normal. When we last spoke, the gold price was on top of 1250 and looked promising, but it's now at 1287. And looks like attacking the $1,300 level again. We're going to start with North Korea, but we're not as convinced as the media is that is the reason why the gold price is rising. Yes, it's a drama, and it might well mature into a limited war in the Far East, if the threats are carried out, of course. But we look behind the scenes. This is not simply a President Trump loud-mouthing about threats from North Korea. And it's not simply a psychopathic president of North Korea, a very murderous man, not really interested in his people. He is trying to basically justify his own position. The dire economic situation of North Korea could well have started a revolution in another country, but by focusing the so-called threat of invasion by the United States, he's managed to rally his people around him. I'm sure by coercion, all these rallies that we've seen there. But those people are terrified of him and will follow what he does. The threat against North America by firing a missile at Guam would seem to be, in the eyes of the North Korea, nobody else, a somewhat defensive and justifiable action by their young president. But the threat is very real in that part of the world. We may well see some action from the United States against North Korea, but they certainly will attack South Korea with artillery, at least. Now, following that, we've got to ask ourselves, is China going to be happy with having no buffer state between itself and the rest of Korea? No. That's why they fought the 1952 war. They wanted that buffer state to stay in position, and it's common policy of all the major powers. Russia did it, America's done it. They need that buffer zone. They need to be able to protect their vital interests, but more than that, prevent the war from spilling over onto their own land. That's really what that's about. So we ask ourselves, the recent jump in the gold price, was that due to North Korea? We doubt that very much. Why? Because we look at the so-called war attitude towards gold. Did people run into physical gold? No. In fact, the only amount that's been bought is 2.8 tons into the gold trusts. The main gold ETF in the United States, the SPDR gold ETF, has seen no selling at all. They've seen no buying either. But what we have seen is a cessation of the sales from that fund, which over the last few weeks has amounted to 76 tons. That's an enormous amount. But it had no impact on the gold price whatsoever. In fact, the gold price during that time was climbing from 1250 to the current level. And we look, well, what else was happening at the time? The dollar was weakening. We called the top of the dollar gold index, and we called the bear market in the dollar. And now today, with the release of the CPI figures, we see the dollar softening again, because those figures are well below expectations, and that has disappointed the market. So we're seeing probably stronger equity markets as they ride this wave that may be getting well extended of a weak dollar. But they realize that the Fed isn't now probably not going to raise rates at all for the rest of this year. They're still implying that they're going to tighten the position with the Fed's balance sheet. They're going to reduce that. But it'll be so slow, it'll be barely noticeable. And the Fed believes that the market won't react if they do that. Could be they're making a mistake because the market is now vulnerable, it's fragile, and it could turn mercurial at any time. So any news of tightening on the back of falling inflation might well precipitate a fall in global markets, not just the US. But it'll be a positive for gold, and we're seeing that at the moment. A falling dollar, rising dollar gold price. Look at it in the euro, it's barely risen. So we can see this is a currency move, not a political move, and not something that gold analysts should get depressed about or excited about. It's just a currency transaction, and gold, after all, does, at the end of the day, measure value in currencies. Something else has been happening, we mentioned earlier too. We've told you that 90% of gold-related or paper gold transactions through London and New York happen. It is the biggest so-called gold-related trading centre, London and New York. But 95% of these are non-physical. Go across to Shanghai, and 100% of gold transactions are physical, resulting at the end of the contract in physical delivery. Shanghai, in fact, accounts for 90% of the globe's physical transactions. And it's been assisted. We know that there's the ICBC Bank, Chinese bank in London. It's one of the market makers. Enormous vault facilities. And we know that HSBC is perhaps one of the main Chinese importers of gold. After all, the name is Hong Kong Shanghai Banking Corporation. Now, these two, we're sure, were quite happy at conducting certain arbitrage operations in the way they like. But now there's a new player in town, LME Precious, and it's linked to the Hong Kong exchange. And it has a contract whereby you can, where you can buy gold loco London, delivery Hong Kong. Bear in mind that gold does not leave China. So when the SPDR sells gold, it's delivered into London because the custodian of SPDR is Hong Kong Shanghai Bank, and they operate mainly through London on that front. So now we have this small player, so-called, that's able to buy in the sales in London, prices lower than Shanghai, and then deliver into Shanghai at prices higher. They don't have to hold the position, they can hold it for an hour if they want, just to smooth out those differences. And we've seen those differences narrow, and because of the increasing costs of speculating in Shanghai, we've seen the price differentials being virtually removed. Indeed, for the first time today, we see Shanghai prices exactly the same as London prices. New York tried to lead the way, but with no physical dealing. So clearly it's a dealer movement of prices based on the currency movements too. So what are we saying when we say this? It's no good to look at the gold price in terms of events in the United States. The United States is not a major physical gold market. If you want to understand the gold market, you have to take all three gold markets, main gold markets, into account and balance the factors at moving prices there very carefully. If you just looked at the New York market and the sales of the SPDR funds, you'd have sold your gold. But if you looked at the global picture, you wouldn't have been tempted to sell your gold and silver. In other words, the US has lost its pricing power. That has moved to Shanghai, and that's why you've seen steady, plodding rises on an almost daily basis, but no spikes, no volatility. It's a quiet market, and we look at the action in Shanghai and we see that's where it's happened and why it's so lacking in volatility, and we expect to see that in the future. Another lesson that we learn with equity markets now getting fragile, fixed interest markets vulnerable, in the States in particular, but also in emerging markets, is that as an investor, you would always be wise to leave the last few percent of market rises and falls to somebody else. Let them bottom pick. You'll find often that you actually got the bottom right because you didn't get that final movement, but likely it was. Right now the dollar remains expensive and other currencies are hurrying to take a chunk out of its dominance. The dollar is structurally weak. The post-election hopes of a reinvigorated USA have faded, so the dollar is returning back to its pre-election fundamentals, leaving the US with negative yields. When markets fall, gold becomes attractive. And another change that we've seen is that it's not just a case of the US equity market investors selling and moving into gold. The three global gold markets move for different reasons. In China, gold is bought for wealth protection and financial security, and it's accumulated and will do so as long as the Chinese middle classes continue to expand. And as the middle class gets richer, so they buy more gold. It's in their, as it were, in their genes to buy gold. They don't trust equity markets. They doubt very much the benefits of investing overseas. They're just out of poverty, so they're not going to be in a hurry to become too clever by half. In Europe, gold is bought to protect wealth owners from unforeseen events that attack wealth. In other words, it's used as a hedge against financial crises. Turning to the US, gold is bought when it begins to rise, because there's a profit to be made. Yes, the wiser US investor buys for the long term. He follows the concept that people don't buy gold to make money. They buy gold because they have money. But right now we see these three global gold markets converging. And we see that gold is not just an alternative to equities anymore, the US perspective. A safe haven aspect hasn't kicked in yet, but the gentle flood of demand in China, and after September, India, is driving gold prices higher and will keep doing so for the foreseeable future. So you add all these factors together and come up with a gold price. You see that the risk-reward ratio for gold is becoming very attractive. Many people are puzzled as to why, with almost full employment, we're not seeing wages rise. We're aware that the jobs that are being found are disposable jobs. Service industry. They're not the sort of jobs that you give to people who have high expertise in any area. And so we wonder, why not? Well, I'm sure each of you looks at your computer on your desk. Many of you probably had a business which employed administrators, secretaries, etc. And now you don't because you have a computer. Spread that concept throughout industry. It affects lawyers, doctors. It affects up to about 50% of all jobs. And it is quite likely that 50% of current jobs will be permanently lost to artificial intelligence and machines. After all, a machine doesn't argue, doesn't demand more pay. It's manageable. So there's every incentive from a profit point of view to turn to these machines. But the fact hasn't yet been absorbed by the economists yet, not in general. In fact, they're surprised. They're still seeing full employment as implying there will be wage inflation, but it's not happening. And today's CPI figures, much lower than expected, reflects the situation amongst people. Job creation hasn't really led to this wage inflation taking off. And we're quite sure that any damage to the recovery makes so many jobs vulnerable. And indeed, if there is a downturn, you're going to see employment drop very rapidly. So in fact, we look at the current equity, fixed interest markets, and we see they're becoming more and more vulnerable by the day. As to the Fed, well, we notice that members of the FOMC are talking to the media in a very dovish manner. We had one the other day who was disturbed by falling inflation, and now by these figures for sure. From 2015, 2016, there was a steady build of inflation, but now it's falling back. And now is it the 7th month it's fallen back? So, as we said earlier, we don't expect a rate hike in 2015. If they do tighten or diminish the Fed's balance sheet, it'll be very slight. And the Fed believes it'll have barely any impact on the markets, but as we said earlier, that might be a big mistake. We see the earnings picture pointing to it peaking in the near term, if it hasn't already done so. So that vulnerability is growing. Now, we're going to finish off with just a point on India. We're just about in the middle of August, and the gold season starts with the festivities in September, big one in October, Diwali, and amazingly, Indians hold around 24,000 tons of gold privately. Reserve Bank doesn't hold that much, but the Indians hold it because they deal in cash. They have an alternative financial system based on gold and property, and they don't like government interference. They don't trust it. It's corrupt. The bureaucrats are corrupt, and so they have this second financial market. Smuggling is rampant, and it's not measurable. It could be over 250 tons, which is a figure put forward by the World Gold Council 2-3 years back. But very little comment has come out about it now. It's a very profitable business, paying over 6% to the smugglers, and it's been in position since they raised the duties on gold coming into the country. It's even the demonetization of the main notes in India didn't stop it. The money launderers got round it quite easily. It consolidated, made them more cautious, but certainly hasn't diminished the trade. In India, in the past, gold demand was dependent on the agricultural sector, which accounted for 70% of Indian demand. But because of the growth of the Indian middle classes and the fact that importers and wholesalers are able to buy well ahead of the seasonal demand, we're seeing Indian demand come in now. It's out of season, but don't read too much into that. The peak of gold, $1921, occurred in July. And so India doesn't dominate the gold price. It adds to it in the third quarter. The imposition of the general sales tax in India was feared, and a lot of stock was bought ahead of it. But it ended up only creating another 0.5% increase in duties. So the stock that was bought by wholesalers ahead of the imposition of the tax on the 1st of July have now run out of stock and have begun stocking up for the gold season already. Bear in mind that when Indian demand does come in, it'll be on top of robust Chinese demand. We also see the fourth quarter of the year seeing renewed investment demand in the developed world markets for both gold and silver, and this is not contingent on any war in the Far East. But it's a defense, but we see it becoming a major factor in the global financial system. So we are associated with a company that holds gold in such a manner it was designed to avoid gold confiscation. It's called the Ultimate Gold Trust / Stockbridge Management Alliance, and you can reach that if you go onto www.stockbridgemgmt.com. If you want to get our newsletter, you can subscribe to that on www.goldforecaster.com. So as we move towards autumn, we wish you a golden autumn. Thank you for listening. We'll be back with the next Gold Weekly when appropriate.